give you a bit of an outline on the funds. I'm going to spend around about 30 minutes talking through the two funds, and then really happy to leave time open towards the end for some Q&A. What I'd like to do is just cover firstly a little bit of an update on the business, how we're seeing the global macroeconomic picture, and then delve into some detail on the actual positioning of the funds themselves, and I'll wrap up with some performance. Can someone just give me an indication? Are those slides coming through clearly enough? Can you see that?
Yeah.
Great, thank you very much. So just a very brief update on the business and the positioning. Business overall, ClucasGray has an asset base now which is in the order of 14 billion rand. The number itself is not that important, other than the fact that we think that it allows us to invest in an appropriately resourced investment team. And what you'll see on the right-hand side there is that the current size of the team is around about 12 analysts and portfolio managers, 9 of whom spend the core of their time on South African research and portfolio management, 3 who have a purely global focus. And then we have 2 other colleagues who are also focused on the offshore side, and for regulatory reasons, they are sitting in the UK, and we don't disclose them on the domestic analyst numbers, but they are very much part of the team. The 2 funds which I'm going to be talking to today are the ClucasGray Equity Fund and the ClucasGray Equilibrium Fund. And if I just move straight on to those, I manage those funds together with my colleague Andrew Vincent. And maybe just to separate them out from the start, because I will talk through them interchangeably through the presentation. The Equity Fund is a South African-only equity fund. It purely invests in JSE-listed equities, and we really don't hold much cash in that fund. That fund would be 98 to 100% invested all of the time. And then the Equilibrium Fund is a Regulation 28 compliant fund. So that we think is an ideal vehicle for retirement savings, retirement annuities, and living annuities. And that meets all of the Regulation 28 compliance features. The objective there in that fund is to, over longer periods of time, generate a return of inflation or CPI plus 4%. So that we'll talk to you in some more detail through the presentation. That fund has been going since January 2015, whereas the equity fund has been going since 2011. What I would like to talk to briefly, and many of you may have seen this before, but we think it's a key component to our investment process, what we call our alpha thesis. And that is that we think that the key drivers of a share price are number one, first and foremost, real growth in the company's earnings, dividends, and cash flows. And then secondly, if we can get a change in the rating or the PE multiple. We apply this methodology and bit of analysis to primarily to stock selection when we're looking at underlying equities, but it also applies to other asset classes, and we use it more widely when we look at other asset classes such as bonds and offshore assets as well. What we've tried to depict on the right-hand side there in that compass is that ideally, if we can find businesses in that bottom right-hand quadrant where we don't pay a high PE multiple, but we can still see a scenario where a company can grow its earnings, dividends, and cash flows. That's a scenario which is very attractive to us. The scenario which we try to avoid is overpaying for a business, so paying too much for a business where the growth is either very modest or non-existent. That for us is a situation where really we will struggle to derive any performance for investors and unit holders. But that is really key to our investment process and what we call our alpha thesis. What I'd like to just delve into now is just a macroeconomic overview. I'm mindful of the fact that it is 5 o'clock on a work day, so I will try to keep that reasonably upbeat and short, and then go into some detail around valuations, how we're seeing both foreign and as well as domestic valuations. I think, in summary, from a macroeconomic perspective, we certainly are seeing a very complicated juncture right at the moment. We have an environment where economic growth is slowing because interest rates have been tightened, and rates have been tightened because inflation in many economies has not come down as quickly as expected. And that always provides a difficult backdrop for certain asset classes, and we'll go into that in a minute. Um, the one thing that we think we're reasonably clear on is that central bankers and policymakers are not going to cut interest rates until they are absolutely sure and convinced that inflation is under control. Um, we don't know how long that's going to take. We suspect that for the majority of countries is going to take place from the beginning of 2024. But the good news, we think, is that there is clearer evidence month by month that inflation in key areas is falling, and we continue to expect it to do so. And what that means is that in due course, interest rates will fall, and that does provide a much more favorable environment for risk assets, bonds and equities alike. Um, the one thing certainly that is notable in the macroeconomic environment is that the US economy has been incredibly resilient despite high interest rates. We'll give you some details as to why we think that is the case. And it also provides us with some sense of confidence that we think in an economy like the US, the base case is that of a soft landing, not a recession and an all fall down scenario. We think that the economy is enjoying full employment, and growth has actually been very resilient. We can't say the same about China, unfortunately. Growth has not rebounded as expected there. And certainly over the short term, we think that has implications for things like commodity prices. And we'll come on to that in some detail too. For the first time in a while, we think that there are some positive signs in terms of reform in South Africa in areas which have been real impediments to growth over the last few years. And we'll talk through why we say that, and two areas around power and Transnet. And as always, we need to ask ourselves the question as to whether this environment, this backdrop, is appropriately priced into underlying securities, and we'll try to answer that as we go through the presentation. So just moving on, you can see this key macro forecast table on your bottom left-hand side. What you will note there is that the global growth expectations over the next 2 years are somewhere between 2.7 and 3%. Historically, what one should appreciate is that global growth has been closer to 3.5%, what we would call trend growth. So what this means is that we are heading into an environment where growth is likely to be lower than it has been over the last decade or so. And I think that with rising interest rates, that is to be expected. In other words, higher rates, as opposed to very accommodative policy around the world, is likely to lead to lower growth. And so moderation of growth expectations is definitely something that we would expect. On the right-hand side, what you see there is courtesy of some macro strategists who we use called Alpine Macro. Um, they run a scenario around something called a growth tax. And that blue line that you see on that chart is actually inverted, but the growth tax looks at a couple of factors. It looks at the oil price, it looks at the dollar, and it looks at interest rates. And a strong dollar, a higher oil price, and higher interest rates amount to impediments to growth. And so that real GDP line, which is in red, is really indicating that one should expect growth to slow down in the near future. One of the things I highlighted earlier is just the resilience and strength of the US economy. And what you can see from these two charts is that the spending, investment spending at a federal level and a government level in the US has really been quite phenomenal over the last couple of years. And this is a post-COVID phenomenon, not just during COVID. You'll see that investment there in manufacturing structures and non-residential private fixed investment has really been very strong. We think it can be attributed to a number of acts which have been passed by the government in recent years, one of which is the Chips and Science Act. It's not the only one, but this has been one of the contributors. And really quite interesting, we think that, investment spend from this act will amount to in the order of $280 billion over 10 years. It's focused in a few key areas: semiconductor manufacturing and capacity, scientific research and development, and skills development. Actually, the largest portion of that budget is allocated to skills development and R&D, and not just to semiconductors. Other areas include health and education. What isn't appreciated necessarily in always is that this CHIPS Act is what's called a dollar for dollar matching act. And so if a private company comes to the US and says, we've got a project for $50 million, they will be matched $50 million by the government. And so you can see the power of what that can lead to from an investment spending perspective. One of the things which has caught everyone's attention in the last few months is the rise in global bond yields. This left-hand chart is just showing you the yield for the US government 10-year bond and the UK 10-year bond. And really what you'll show there, what you can see there, is that we've now got back to levels that we last saw somewhere between 2006 and 2008. And so that has a couple of implications. The first implication is what you'll see on the right-hand side of your screen, where you've now had negative returns from bond markets for 3 consecutive years. That's very unusual. We've had negative returns, as you can see, in single years, but generally you've had a recovery. We've now had 3 negative years in US bond markets. And the other thing about bond yields, which is worth noting, is that they have the effect of repricing assets. So everything from mortgages to lending rates gets affected, and ultimately a higher cost of capital also has an implication for equity valuations, because you are simply discounting back valuations with a higher cost of capital. So that's certainly been a real feature of the last quarter to 6 months as these yields have changed in the global environment. On the more encouraging side, inflation has really been stubbornly elevated over the past couple of years post-COVID. We do see some signs of easing. What you'll see on that chart on the right-hand side is we're currently sitting at headline CPI in the US of around about 3.7%. And you can see the longer dated picture of inflation and exactly how that has fallen over. So the things that really are still remaining elevated are things like food, CPI, and shelter, which you see on the left-hand side. So shelter inflation, went beyond 8%, and is now trending back down towards 4%. So certainly we see this trend continuing, and we think that in due course inflation will come down. I'm not sure if someone wouldn't mind just muting there. I'm just getting a little bit of interference. Thank you. The one thing that we certainly do acknowledge in the near
Nach
term
100 Metern links
is
abbiegen in die Straße
the risk
Berthold
of
Boulevard.
oil in the near term. Oil in the near term poses a risk to inflation. As you'll see on that right-hand chart there, energy inflation has been negative. But if oil rises, we could see some inflationary effects come back onto the table. And just moving on to that, what you'll see in this chart is that oil, as a result of a number of factors, has moved up around about 30% over the last quarter to the end of September. A number of factors have driven this. A change in the level of U.S. oil reserves, and more specifically, and alarmingly, what we've seen on our screens around geopolitical tensions around the world, and specifically in the Middle East. So really, the risk to inflation here is palpable. We really would prefer to see this come down. From a portfolio context perspective, I'll talk to this in some detail. We think that it's appropriate to protect yourself against a rise in the oil price and in overall energy prices. And we're able to do that through companies like Sasol, like Exxaro, which remain holdings in both of these portfolios. The two issues which I said that I would touch on around some slightly more positive signs in reforms in South Africa revolve firstly around Transnet. You can see the problem that's evolved on your right-hand graph, where general freight, iron ore and coal volumes have really declined quite precipitously over the last 3 years. We're seeing some first signs of action, that the change is underway. It will take some time, so I don't think we are getting carried away as to this being fixed overnight. But certainly, there's more encouraging reforms underway, and this has obvious consequences in terms of improving export volumes, better revenue for companies, better revenue for the country, and we really need to see this get resolved. The other thing which you'll note, just in terms of the macroeconomic forecasts in that table, courtesy of Standard Bank, is that into 2024 and 25, expectations for inflation are to come down to below the 6% level. That would allow the Reserve Bank to adopt a bit more of an accommodative stance. And what you then see is that the expectation for interest rates, which is in that green bar, the repo rate, is for that to begin to come down into the course of 2024. So we certainly are expecting that to be the case. The other issue, which is forefront on everyone's minds, is of course the power issues. And what we just show here are two things. The first is a chart from Eskom themselves, just showing the expectation for Koeberg, Kusile, Tutuka, and then in due course Majuba in March 2024 to come back on stream. Long story short, what does this mean? The reality is if that comes to fruition, this removes 2 stages of load shedding, and the availability for Eskom, the availability factor for Eskom, we think could improve quite substantially over the next 6 months. We've all, I guess, been learnt not to get our hopes up too high, but certainly some of those projects do seem to be a lot closer to being completed now than we've seen previously. And then on the right-hand side, this is slightly busy in terms of the numbers, for which I apologize. If you can just focus on where the red arrow is. There are 2 important line items there. One is the REI PP program, and that is these large solar and wind projects which will hook up to the grid. And then secondly, industrial private supply. and that is not rooftop solar. That is companies and industries who have built private supply. And the thing to note there is that between 2023 and 2025, there is a very significant pickup in the improvement of power generation from those two sources. What we think this means really is that within 6 to 12 months, we think there's a very serious alleviation to the problems that we are currently encountering. Maybe just to move on to equity valuations now, and I'll go through global sorts first, and then we'll move on to some of the domestic valuation issues. The chart on the right-hand side there, that table just depicts estimates that we do to try and forecast what the expected returns out of various parts of the globe might be. We use what we think are long-term reasonable assumptions with regards to exit PEs, as well as earnings expectations. And what you'll note is that the returns that we expect over the next 3 years from a number of the US indices, something like the S&P 500, is only around about 3%. So a pretty modest return expectation currently. This can, of course, change. If you get a change in policy rates, the expectation for those returns can improve, but that is how we currently see the landscape with slower economic growth. What you will also note is that other regions like Europe and emerging markets certainly look as if they are providing the potential for much more positive returns. And that's certainly an area which we've looked at in the Equilibrium Fund and have positioned the fund for that accordingly. The chart on the left is very interesting. This strips out the US, and it just shows you what the All Country World Index, excluding the US, looks like relative to the S&P 500. And really, this is at a 30% discount, and we are now at the largest discount that we've seen in 20 years. So other regions really do look pretty attractive relative to the US at this particular point in time. What I noted earlier, however, is that we do acknowledge that the US does deserve a premium based on the fact that growth and investment, certainly across the developed world, has been superior in the US to many other regions. This just illustrates the point differently. What we say here is that there's been a very narrow leadership of companies that have driven performance in the world index. We're talking about 7 to 10 companies. So the chart on your top right there just shows you that the top 10 companies in the S&P 500 are now trading on a rating of just under 26 times as a multiple. The long-term average is 20 times. So really quite a significant premium to that long-term valuation. The remaining stocks, in other words, the rest of the 490 are trading at around about 16.8 times. Their long-term average is 15.7. So still a premium, but not as significant as the top 10. Another way of showing this is that the chart on the left shows you the Russell 2000, which is an indicator for medium and smaller sized businesses in the US. That red line just indicates that you've had absolutely no performance from those stocks since 2021. And that really just exacerbates how this small range of technology businesses has driven performance. What we do think that it means, though, is that for stock pickers and other people away from an index, there are opportunities beginning to emerge in these other 490 companies and smaller and medium-sized companies. Moving on to South Africa, I think that there's no one in this audience who wouldn't be able to probably explain the challenges that companies have faced over the last few years, and we have arrived at a place now where the multiples in South Africa are extremely cheap. We are now trading at more than a 20% discount to other emerging markets. And the bottom right-hand chart just shows you the forward PE multiple of the JSE. We really are in cheap territory relative to history. That chart goes back to 2006. What we think, though, is that looking forward, we are at a place where companies are trading on extremely undemanding exit PEs, as you'll see in that table, and very attractive dividend yields. Many of those dividend yields are actually more than what you're going to be able to earn in a money market or bank account. And so we think that a lot of the negativity that we've experienced in the country for some time really does look to be priced in. And to be buying companies on 5, 6, 7, 8 multiples relative to history is a very attractive starting point. What we're showing you on the top right-hand graph there, the blue Manhattan bars are companies which we own in these portfolios. And what you'll see is that the lowest Manhattan has an internal rate of return or an expected return of more than 15%. So our analysis indicates to us that from this point, we think that the returns from a number of these companies should be very attractive going forward. Similarly, on South African income assets, we've all seen where interest rates and bond yields have gone. That chart on the bottom left-hand side just shows you when you can now earn 9.2% on a 12-month fixed deposit or NCD. The bond yield is sitting at 12.4% as we speak. And if we correct around our assumption on inflation that it remains at 6% or below, you can see that the real return, in other words, the return above inflation, is really quite attractive, somewhere between 6 to 7% on South African bonds. We'll talk to this in a minute, but that is the reason why we have quite a significant position in the Equilibrium Fund in bonds, both corporate bonds as well as government bonds. I guess that on everyone's lips is the rand, and where does the rand go? What you'll see on that left-hand chart is that the rand really has had quite a tough year to date. We're down about 10% to the dollar, not as for the year to date, not as weak against the other currencies, but relative to history, and this is a chart around purchasing power parity, the rand is at very elevated and weak levels. What we're highlighting here is that we have had previous occasions where we've had a relatively very weak rand, going back to 2001 and 2, 2015 and 16, and in COVID in 2020 and beyond. And certainly, experience has illustrated that those extreme points in subsequent periods do lead to some rand recovery. And what that means is that rand assets have historically performed pretty well from those elevated levels. And that includes both bonds and equities. That chart on your right-hand side there just shows what happened to subsequent to 2001, when we had a very weak starting point on the rand. You had quite strong all-share returns in rands, and not such a strong performance out of the S&P 500. We don't know whether that repeats itself, but certainly it's a good indicator that we should be careful about being too negative on the rand at current levels. What I'd now like to do is just move on to the positioning of both the equity fund and then onto the Equilibrium Fund. So this is the top holdings, the top 15 holdings for the equity fund. You'll see them listed there on the left-hand side. A point to note is that those top 15 holdings make up almost 70% of the portfolio. The portfolio at the moment has 29 holdings in it. We have a range of between 25 and 30 holdings. And what that means is we really like to make the positions count. If we've done the homework on a business and we believe in its ability to provide returns, we need to make that investment count. So we have a a guideline where we will always have a minimum of at least 1.5% in any company, and we restrict ourselves to a maximum weighting of 10%. For risk reasons, we think that it's appropriate to not exceed 10%, and we have more than enough scope to have high weightings in other businesses. There are a few differentiated holdings in the portfolio that you'll see there on the top right. Reunert, which we think is a beneficiary of the power challenges that the country is having. Businesses like Adcock and Metrofile, Kaap Agri, which is KAL, Grindrod and AECI, and then Ethos Private Equity. The rest, you would recognize many of those names in terms of large top 40 companies. What we've done here is just given you a further breakdown of various metrics in the portfolio. On the right-hand side, you'll see that the portfolio is well exposed to South African financials, that is banks and insurance companies, about 26% of the portfolio. South African industrial companies, 20%, and then mining resources, pure mining resources, 14%. And other resources would be 9%. That would be something like AECI would fall into the category of other resources. So a good spread across different sectors. The top left-hand table just shows you the current weighted PE multiple of the equity fund, which is around about 8 times, and a dividend yield of over 6% as we stand. The JSE comparative to the right there is just under 10 times and just under 5% in terms of a dividend yield. So we think that the portfolio, is holding assets which, in our view, are attractively priced at the current level. The one interesting factor to note is that we think that almost 50% of the portfolio companies are currently either doing buybacks or are in the process of considering doing buybacks. It's an extremely high number, not a number that we've seen, not in my investing career, and it's a very strong theme, and we think an underpin to the fact that the companies themselves also believe that share prices are very undervalued at the current level. So just an interesting stat that we picked up. I'm going to move on to the Equilibrium Fund now. As I said, I'm very happy to come back to any questions on the equity fund in due course, but this is the current asset allocation of the Equilibrium Fund, or the balanced fund. You'll see there we have a guideline on the table on the left-hand side of between 45 and 55% in South African equities. We're currently sitting at 52%. We currently have around about 5% in listed property. We have a very healthy weighting in cash, bonds, and preference shares. That's 23% of the portfolio, and the global weighting sits at 20%. A point to note on the South African equities is that the equities in this balanced fund, in the Equilibrium Fund, are a mirror of what I explained to you slightly earlier in the equity fund. So we own the same equities in both funds, obviously just in slightly different ratios. What I like to do now is just give you some sense of how we make asset allocation decisions and how we allocate money between the different asset classes. This is key to our process, and we look at what we think are prospective returns over a 3-year time horizon. We look at things like PE multiples, earnings prospects, and what do those returns look like relative to our target of inflation plus 4%. So that's the horizontal green bar that you see is inflation plus 4%. We use the high end of the inflation band, which is 6%. So that green bar is 10%. And we're looking for assets which we think can generate us a return higher than that 10% over our 3-year forecast time horizon. What you'll note is the blue Manhattan bars. Those are domestic assets, so domestic banks, domestic bonds, the resources counters. Those we think are giving the opportunity to earn returns of north of 10%. Then the green Manhattans are foreign assets, and you'll see Euro stocks and emerging market equities feature more strongly there than US indices, as an example. So what we do is try and position the portfolio around where we are seeing the best opportunity set to generate those real returns above inflation. More specifically, just to give you some detail on the breakdown across the different bands. So we have a total global allocation in this fund of just over 20%. The majority of that sits in equity. We do hold one corporate bond. It's a dollar denominated bond, which is yielding over 9% in dollars. And the rest of that is all allocated to equity. We were sitting on some foreign cash. Into the rand weakness, we've actually brought some of that back and redeployed it into South African fixed interest investments, earning in excess of 9 and 9.5%. Just a bit more of a breakdown on the equity exposure within this fund. So equity is around about 18%, foreign equity, that is. You'll see in that pie chart on the right that 60% of this is global. What we mean by that is that there's a fair predominance of managers who manage to a global mandate. So there would be quite a lot of US exposure in there. And those two managers, the one is called Veritas Asset Management, and the other one is called Dodge & Cox, which is a value-orientated active manager who we've recently allocated money to. In Europe, a healthy allocation of around about 20% of the equity to Europe, based on the attractive valuations that I alluded to earlier. Japan is around about 12%, and we do have a direct holding in British American Tobacco in the offshore component as well. Then just to give you some more detail on the fixed income part of the fund, the fixed income, which is cash, bonds, preference shares, and fixed deposits, amounts to about 23% of the portfolio. These assets combined are generating a current running yield, in other words, an income yield of about 10.8%. We think this is a very healthy underpin for the portfolio, with having more than 20% of the fund earning us almost 11%. And that's split across a number of different bonds. As I alluded to earlier, it's government bonds, it's corporate bonds, fixed deposits, preference shares, and some cash rates as well. I'm going to move on to the performance of the two funds now, and then wrap up. This is the performance of the equity fund, and we've given you this over 1, 3, 5, 7, and 10 years, and since inception. But over the last 12 months to the end of September, the equity fund has generated a return of 13.3%. The index, the JSE SWIX, the Capped SWIX index, has generated 11.9%. So some outperformance of around about 1.6 over that index. The 3-year returns post the recovery in COVID have been really quite encouraging. That's a compound return of 24.5% over the last 3 years. The index has done 13.8%. So, investors and unit holders who've held the course over the last 3 years have been rewarded with that recovery. The 5, 7, and 10-year numbers are there for you to see, but important for us that we think we need to be able to, certainly try to outperform that JSE index over sustained periods of time. We do make the point on this slide, though, that it's difficult to do it all of the time. That's clearly our objective, but there are periods where, if we're going to position the fund differently to be able to perform over the medium term, there are times when we are going to underperform. You'll see that one such period was 2020. excuse me, but a strong recovery in subsequent periods. So, you know, our approach here is that we do obviously aim to deliver alpha over time, but it won't happen all of the time. And then on to the Equilibrium Fund. Again, we're talking about the same period to the end of September. Returns, you'll see in the green highlighted row there, 14.2% over the last 12 months, 15.9% compound return over 3 years, and then just short of 9% over 5 and 7 years. So the point to note on the 5 and 7 years is that we are short of our objective of 10%, but hopefully we can get those numbers up in due course. The 1 and 3 year numbers are encouraging from the perspective that unit holders have earned decent real returns, relative to inflation, which has been in the mid to high fives and low sixes over that period. What we do give you is some additional information on the bottom, the blue row, and that is a survey of balanced funds, which is done by a company called Willis Towers Watson. There are 39 funds in this survey, and this fund has been in the first quartile over 3, 5, and 7 years. We're currently sitting in the second quartile, so 11 out of 39 funds over that period of time. So just to give you some sense of the comparative peer group numbers there. I'm going to leave it there and open up for Q&A and take it from there. But thank you, everyone, and over to Q&A. What we certainly are also very happy to do is if there are individual questions which you would like to put to us on email or a follow up, by all means we are very happy to do that. Everyone happy?